You've been following the investment gurus religiously. Reading every Warren Buffett quote, watching Cathie Wood's interviews, maybe even buying ARK funds because innovation is the future. You're doing everything the smart money supposedly does, yet your portfolio looks nothing like their legendary track records. Here's the thing, you're not wrong to follow them, but what you believe about their recent performance is catastrophically incomplete. I've spent years tracking what the smart money actually does through their mandatory 13F filings, and I decided to run a brutal test, backtest every famous guru's disclosed holdings against the S&P 500. Let me start with Warren Buffett because this one hurt to discover. Over the past 5 years, if you replicated Berkshire's top disclosed holdings, you would have earned 8% annually for a total return of 52%. The S&P 500 during that same period? It beat Buffett by 32 percentage points. The Oracle of Omaha, the man whose letters we quote like scripture, has been trailing the index by a significant margin. But here's where it gets really interesting, Buffett wasn't even close to being the worst performer. Cathie Wood became the face of innovation investing, with retail investors pouring billions into her vision of the future. So I backtested her ARK Invest flagship holdings against the market benchmark. Wood's portfolio generated 10% annually over 5 years, totaling 61% returns, which sounds decent until you realize the S&P 500 still outperformed by 23 percentage points. The woman who was supposed to revolutionize investing with Tesla, genomics, and AI stocks couldn't beat a boring index fund. Even more shocking, she actually performed better than Buffett in this timeframe. The innovation narrative that captivated millions of investors delivered underwhelming results when measured against the simplest possible alternative. But here's where the story takes a dramatic turn. While the household names disappointed, some lesser-known legends were absolutely crushing the market. Michael Burry, the guy famous for predicting the 2008 crisis, delivered 38% annual returns over 5 years for a staggering 404% total return, beating the S&P 500 by 320 percentage points. Ray Dalio's disclosed positions generated 29% annually, and Chase Coleman hit 28% per year. These aren't household names like Buffett or Wood, but their actual track records make the famous gurus look like amateurs. The pattern emerging here isn't what anyone expected. Fame and recent performance have an inverse relationship. Before you rush to copy any of these portfolios, here's the critical caveat that changes everything. These numbers represent simplified backtests of disclosed 13F holdings, not the actual returns these investors earned. The 13F filings lag by about 45 days, only show positions over $100 million, and these managers are actively trading between quarterly reports. When Burry files showing Tesla puts, he's probably already moved on to his next trade. Past performance absolutely does not predict future results, and what worked for 5 years could completely reverse in the next 5. This is educational analysis, not a roadmap you should follow with your money. The biggest surprise wasn't who performed best, but who performed worst. Carl Icahn, the legendary activist investor, generated just 6% annually, trailing the S&P 500 by 49 percentage points over 5 years. Terry Smith, often called the British Warren Buffett, managed only 7% annually. These are investors with decades of success who got crushed by simply buying an index fund. It reinforces a harsh truth about investing: past legendary status means absolutely nothing for future performance. Even George Soros, who broke the Bank of England, delivered just 14% annually in his recent disclosed positions. Here's what this data reveals about our relationship with investment gurus: we're worshipping past performance while ignoring present reality. The media amplifies every move by Buffett and Wood because their names generate clicks, but the actual numbers show they've been mediocre to poor in recent years. Meanwhile, managers like Burry and Dalio who are crushing it get far less attention because their names don't trend on social media. The lesson isn't to abandon all investment wisdom, but to understand that no investor stays hot forever, and celebrity status often peaks right when performance starts declining. This is why blindly copying anyone's portfolio is financial suicide. So here's what you can actually do with this information. First, stop treating any investor as infallible, even legends have rough decades. Second, if you want to track guru portfolios, use them as idea generators, not blueprints to copy. Third, remember that by the time you see a 13F filing, it's ancient history in market terms. And finally, consider whether you're better off just buying the S&P 500 and beating most of the famous names. You can explore all these backtests in detail at nexusaicalls.com, but remember, do your own research, and never invest money you can't afford to lose.